Prolonged liquidity stress could be a significant credit risk for non-bank lenders in India. That's according to Moody's Investor Service. They came out with a report last week in which Moody said that NBFCs can cope with a multi-week period of tight liquidity. However, if that tightness persists beyond that, credit profiles could weaken. Let's get more details on that with Srikanth Vadlamani, Vice President, Financial Institutions Group at Moody's Investor Service, joining us on the phone line. Srikanth, good afternoon. Thanks so much for joining us. There were some important takeaways in your report, but I'll start with the most immediate one. You did an analysis of their liquidity profiles, and you came up with the conclusion that they can at most tide over a multi-week liquidity stress scenario. As things stand, it does not look like this liquidity stress is going to go away for the NBFC sector in a hurry, though.
I mean, so far things haven't really improved a lot. I mean, the market conditions remain quite stressful. I'm not sure if the market borrowing window has really opened up. So clearly the liquidity conditions remain challenging. I think the point we're trying to make there is that when we think about how NBFCs in India have managed their liquidity, it has been primarily almost solely through asset liability maturity matching, and the asset liability maturity matching is seen to be very sacrosanct in the very near term buckets. So as the buckets go a bit further out, typically we have seen finance companies take a bit more liberty in terms of trying to manage interest rates, trying to time their borrowings, and so on and so forth. And hence, beyond a very short-term bucket, they would open up themselves for more risks.
Okay. Srikanth, so, I think the short term is the issue right now. So as things stand, it's not like the CP market is entirely shut. There are deals happening. They're happening at slightly higher cost, but perhaps not in the quantums that some of these NBFCs would want. But their options are only three, right? Either they raise it from the markets, refinance, rollover, or they get it from banks. But banks seem to be constrained or, at least cautious on lending to NBFCs, or they sell down assets, which is probably a slightly longer period process.
Sure. I think right now the strategy I would think most NBFCs would be adopting in the market is just to make sure that they have enough funding and liquidity to be able to meet their existing obligations. I don't think at this stage they're really thinking about growth and how they're going to fund their new business. So it's really, I think the way they would think about it is that clearly there would be inflows coming, and there is a level of comfort in the ALM management, and whatever gaps are there in the ALM management, they would want to try to plug in with what you're talking about, and I would think that bank funding would be the primary line of defense as of now. So from a growth perspective, which obviously would entail some amount of funding needs, I don't think that's on the table right now.
Okay. Srikanth, there was a chart up on the screen while you were talking, which gave the breakup across different categories of NBFCs in terms of their liquidity management. And housing finance, ironically, may be the strongest in terms of asset quality, but it seems like they may face the toughest sort of short-term liquidity problem because their liquidity holdings seem to be at the lowest end.
It is. I mean, it's coming from, I think, two reasons. Number one, first of all, I mean, just to give a perspective, obviously the housing finance segment is the biggest segment of the NBFC space. And now the reason why they seem a bit weaker from the ALM from a liquidity management perspective is that obviously they're dealing with a longer tenure product. So obviously, housing, we're talking about 15-year, 20-year tenure. That is number one. The second, more subtle point, which I think does not actually get reflected in the numbers, but I think it's a risk depending on how long this prolongs, is that other than the traditional simple mortgage financing, which is basically you're lending to somebody to buy a house, we have seen the HFCs getting into non-traditional products, either in the form of LAP segment or in the form of some sort of corporate lending, basically lending to developers, those sort of structures. And the risk there is that they have the sort of repayment assumptions on those sort of products have been built in, assuming that the prepayment rates will remain high. So for the LAP product, the contractual tenure would typically be either 10 to 15 years, but the actual prepayments were very high, and hence the product used to get repaid between maybe 3 to 5 years. So the risk is that those prepayments won't come in now because the overall liquidity in the market has dried up, which would make the ALM profiles actually worse than what they seem on paper.
That's an important point, Srikanth. So is that specific to LAP, to the LAP product only, or is this also developer loans which you mentioned?
I would think both, because ultimately the reason why developer loans, conceptually speaking, are a way in which developer is getting liquidity from these firms till the actual sale happens, and the liquidity is substituted by the fund by the sale of the apartments and the actual money coming from the actual buyers. So the ability of the developer to really repay or prepay is not as much a solvency issue as it's a liquidity issue. So that is definitely a risk that is there.
Okay. Srikanth, so far what has been done by both the central bank and to some extent by the NHB by saying, we'll do higher refinancing, and the central bank trying to incentivize banks to, do incremental lending to NBFCs. What do you make of that? Seems, sort of minor tinkering in the midst of a relatively larger problem.
Yeah, I think that the main, from a materiality perspective, I would take out the actions that RBI is taking as being more material. I'm not sure how effective they have been, because essentially what RBI has done is that it has said we are providing more liquidity to the broader market, and now it is up to the system to make sure that liquidity reaches to whoever is in need of the liquidity. But the issue probably in that sort of mechanism is that ultimately a bank may have the liquidity, but whether a bank is willing to lend to a particular counterparty or not is not just a function of the bank having liquidity, but the bank also being comfortable with the credit risk of the counterparty. So theoretically speaking, RBI actions have pumped in a lot of liquidity into the market. So banks, I think, definitely have the balance sheet capacity to at least provide short-term liquidity. But whether it is really happening or not, I don't think it is happening to a very meaningful extent right now, at least.
Okay. Srikanth, a lot of NBFCs are coming out giving statements saying that they're looking to sell, X thousand crore in loan portfolios. SBI, of course, has said that they are willing to purchase up to 45,000 crore. But, beyond SBI, it doesn't look like too many banks can do it. The private banks which have the capital don't have the headroom on their loan to deposit ratios. The public sector banks which have headroom on the loan to deposit ratios don't have the capital. So it's sort of a one or two bank story in terms of purchase of these loan portfolios from NBFCs, isn't it?
I think what you've raised is a very good point, and that's a very important conceptual construct, that the banking system is impaired from a capital perspective. We all know that. Over the last 5 years, that impairment really didn't get reflected in any other part of the economy, because somebody else was stepping in. And right now, whoever was stepping in, which is the NBFC space, is now impaired, and banks don't have the capacity to step in a very meaningful fashion because they are not liquidity constrained, but they are capital constrained. And hence, your point is very much valid that even in their ability to support the NBFC sector itself, they would be constrained in terms of the balance sheet expansion. They would also be constrained in terms of the sectoral concentration that they would be comfortable taking in. As it is, the loans to NBFCs for the banking system account for around 5% of the overall loan book. Obviously, some of the banks have more than 5%. And as a prudent measure, you wouldn't want your exposure to a particular sector go beyond a certain limit. So because of, while there's abundant liquidity, these constraints, either in terms of capital constraints or in terms of the sectoral limit constraints, would limit the sort of help that the banks can actually extend at this point.
All right, Srikanth, our last question. I know in your note you said that your base case scenario is that the regulators will continue to sort of take measures to ease this story or ease the situation. But you also pointed out that there is significant credit risk. It's important because of the amount of money that, these NBFCs were raising from the market. That and also the fact that, credit to the entire system, NBFCs have been playing a large role in it. So you would think that both from a large economic standpoint and an NBFC standpoint, more action would be required from a regulatory standpoint?
See, I think what is very clear is that the non-banking sector, NBFCs as well as the capital markets, have played an increasingly important role in providing credit to the economy. So definitely the squeezing of the credit channel will impact, I think, will have some negative impact on the broader operating environment, which again sort of comes back to a negative loop when we think about the banks. Now, as far as the regulatory action is concerned, I think what we can say so far is that regulators have taken significant action, but it was more of indirect action, and at least so far, the traction of those measures seems to be limited.
All right, Srikanth, I really appreciate you explaining some of the finer points of your report. Moody's had that report out last week. You found it on Bloomberg Quint as well.